So often we hear the question, how do I handle Roth conversions when I don't have any cash available to pay the taxes? Look, if you've been told that you need cash to pay taxes on Roth conversion, you're not alone, but what if I told you that's not always true? So in this video, I'm going to cover some smart strategies for converting to a Roth IRA, even when you don't have a ton of liquid cash available to pay the taxes. You know, a lot of retirees and IRA millionaires want to convert, but they hesitate due to the hefty tax burdens from converting those large IRAs and 401ks, but not converting can lead to even higher tax liability down the road due to what happens to the size of your required minimum distributions and the other taxes you get hit with because you have the large taxable income like IRMA penalties or IRMA surcharges and higher Medicare premiums. Today, I've got 5 specific ideas that I want to help you figure out kind of which is going to be best for your situation. So just so we're on the same page first, let's just kind of talk about this Roth conversion dilemma, if you will. So you want to convert pre-tax IRA money into tax-free accounts, Roths, right? But conversions create taxable income and taxes are due in the year that you do that. So if you don't have spare cash, it seems like kind of you're stuck. But the reason that you want to make sure that you get focused and you're able to do this is that when you do conversions properly, and heavy accent on properly, you're going to reduce a lifetime of tax liability. You're going to avoid potentially higher tax rates in the future, or even the same rates, but on a whole lot more money later on because of the growth of those accounts. You're going to eliminate your future RMDs altogether if you're really smart about it and you pull all the strategies together. And you're creating this tax-free asset for your heirs, and they're going to love you even more for it. I mentioned I had 5 different strategies. So here's strategy number 1 to jump right in. Number 1, reduce or eliminate your current 401k contributions if you're still working. So the concept on this is use cash that is currently going to additional savings in a more beneficial manner. So for example, let's say you're making current contributions between you and your spouse of like 30 grand a year. Stop the catch-up contributions and stop contributing anything in excess of any matching provision that exists. The result is you have that $30,000 that you can use to pay taxes on conversions. So what that means at the end of the day is you redirect the cash, you use that cash for taxes now. So that 30,000 could have gone into your 401k, which creates an additional, it just adds to the problem of what you're researching, which led you to this video. Or you can use that $30,000 to pay the taxes on converting, depending on your tax bracket, $100,000 to $120,000 of existing 401k money. And I promise you, if we do the math for you and you look at it, you're going to see that you're much better off by converting that 100 to 120 than to adding another 30,000 to that. So one caveat, one warning, if you're not already 59 and a half, you may have other considerations that you got to factor in to avoid early withdrawal penalties on taking some of that money and doing conversions on it. It really depends on your plan, document what they're going to allow you to. So there's some questions that you probably need to ask. All right, so the second strategy is use IRA withdrawals to cover the taxes. So just simply use money out of the IRA to pay the taxes. A lot of people think, well, I can't do that. My account will go down too low. I can't afford it. And some of those may be true, but if you're an IRA millionaire and you're not already planning on pulling a bunch of money out of the IRA for living expenses, this probably will work for you just great. You know, I think of an early client I had like, I think it was 1.7 million in IRAs, and they converted it strategically over a period of several years. And the result was that they still, even using the money from the IRA to pay the taxes, they still avoided $1.5 million in tax, and their tax adjusted net worth in their late 70s and early 80s was no different than would it have been had they not done the conversions. So it's really a myth that you can't take money out of the IRA. Now, there are circumstances that exist that could cause a problem, and I've already alluded to that, which is that if you're planning on using funds out of the IRA really soon, and much of those, then that probably would be taxing the IRA too much. Strategy number 3, leveraging other tax-free funds. So what about taxable brokerage accounts that you've got highly appreciated assets? You can do some tax loss harvesting to offset some gains. You can pull money out of that. I've done another video on how to deal with the capital gains issue on that. It's not as big a deal as what you might think. In fact, we would prefer we see by the math that if our clients use those highly appreciated assets and pay capital gains, they're better off than to take the money out of the IRA itself. And of course, cash is always the best if you have it, but that's not what this video is about. The other thing is you maybe have been putting money into a cash value life insurance policy for a long time that maybe have a policy with a loan provision that you can use that as a tax-free way to pay for some conversions. And on a few rare instances, we've actually watched where home equity line of credits work, where they, as long as you have solid income and a lot of assets to know that you can repay it. We've actually seen a few of those work where they borrow against the home equity at a very low interest rate to pay the taxes and then repay that over time from the Roth IRA or other assets. That's a strategy you got to be kind of careful with and have somebody that knows what they're doing kind of walk through that and lay that out in a strategy for you. But by the way, if you like this kind of stuff, I've got a couple more strategies for you. But if you like this kind of stuff, hit the like button. It helps us a lot. YouTube recognizes that people are watching and they stay engaged. So if you'll hit that and then subscribe to the channel. But if you want to, hit the bell so you don't miss whatever our next deep dive is into retirement tax planning. All right, strategy number 4 is really just understand that normally speaking, the best Roth conversion plans are multi-year plans. So you break up the conversions, not only to manage the taxes, but to give your account time to kind of grow along with it so that you don't see a big dip in the value of your account. Your optimal game plan is going to it's going to require a conversion over a period of time. And we've found that 4 to 7 or 8 years is a sweet spot for what we see happening. But finding the optimal game plan is going to innately provide you with the maximum tax advantages and net worth. That's how we know it's optimal. If you convert too slowly, you're going to pay a lot more in tax than what you needed to, like going to the top of your current tax bracket. That maybe is a strategy, but you'll end up, we've seen a lot of cases where the client actually would pay a lot more money in tax over their lifetime by doing it that way because it was too slow. Or the opposite, you could do it too fast. If you do it too quickly, it reduces your tax adjusted net worth more than what need be compared to finding that optimal strategy. A 5th strategy is really using charitable giving to offset the taxability. So if you're somebody who already is a donor, and you're maybe making regular contributions to your church or some other 501c3 that are significant. I'm not talking about just a couple $1,000 a year. I'm talking about, 5, 10, 15, 20,000 plus. Then there are strategies that you can use that I've done other podcasts and videos on that are called donor advised funds. You can always use something called a qualified charitable distribution once you get to close to RMD age. Those are 5 ways that you can kind of just take into consideration to help you save some taxes. So if you're serious about maximizing your retirement strategy and you're tired of leaving future money on the table with unnecessary taxes, we got 2 options for you. First, click the link below and watch our exclusive on-demand webinar. It's packed with a lot of actionable strategies that I'm going to share with you and real-world examples. It's going to help you maximize your own personal retirement strategy with a properly executed Roth conversion game plan. And if you're ready to take a step further, schedule a free strategy call with our team. We're going to walk you through how to apply the strategies to your unique situation, show you the exact steps to protect your wealth, minimize your tax burden, and we're going to set yourself up for long-term financial success. So whether you watch the webinar, book a call, or both, don't put off this one thing that's very important. Every day you delay could cost you thousands and thousands in additional income tax. So don't forget to subscribe, hit the bell so you don't miss our next deep dive on retirement tax planning. Take care. Have a great day.